Good morning, everyone. My name is Mark Lyons. I'm the Director of Sales here at Senior Market Sales, and I'd like to welcome everyone to this month's life insurance webinar. We have a special guest here today. This is our newest Regional Vice President from Columbus Life, Mr. Jeff Tabor. Welcome, Jeff.
Thank you. Thank you. Glad to be here.
Yeah, we're glad to have you. So Jeff's going to go through his presentation, and he's going to really talk about why Columbus Life. I think we've talked a lot about Columbus Life here internally and with our agent advisor base, and we think that's a really great company. Based on my background, what Columbus Life offers is very similar to what I always preached in the past, honest products. You're going to tell the people the truth. You have a lot of great benefits. You have a lot of great features. And really, Jeff's going to go through this today. I've known Jeff for a long time. I think we probably met, maybe 20 years ago. And our paths have periodically crossed. So he's a insurance industry veteran. He has been around a long time. And maybe just tell everyone a little bit about your background.
Sure, Mark, thanks. Hey, everybody. Good to be with you. Yes, I'm third generation insurance. I mean, second generation, dad was in it full time. Grandfather was in it a short period of time doing Farm Bureau years and years ago. But dad had a brokerage agency in the early 80s. That's where I got my first start, ran my first illustration in 1982. It was E.F. Hutton. For those of you
wow,
folks that have been around a long time may remember those guys were some of the early pioneers of the UL product. And what we're here to talk about today is IUL, which is the sort of next step along the way. But it's been a long road.
It's a good thing that we, the average age of the insurance agent in America today is as of a certain age that they would remember the E.F. Hutton ads. So
quite right.
Anybody that's 35 or younger, like, I don't know what that is.
Yeah. Yeah.
I'm sorry. Go ahead.
No, but you touch on something that's important, and there are a lot of the companies that I was doing business with back in the 80s are no longer there. And that's been a continued trend. I'll talk about it briefly in my presentation. But, from there, I went into an insurance company, direct relationship, then into a home office. I've had my own agency, done a variety of things, all been good, been in retail sales on the security side and as an OSJ, and sat on the board of a broker dealer. So I've had sort of a wide swath of what we call the industry, and it's been great. It's been good to me and my family. But it's also been a good path because it's led me to good people like Mark and organizations like SMS. So pleased to be here and share a little bit about Columbus.
Well, and that's great. And Jeff and his wife and two daughters live in Grapevine, Texas. So are those daughters married yet, or do you still have to pay for weddings?
No, we're done with that. They're all out of the house. In fact, 3 grandkids. So
okay, congratulations.
Now
congratulations.
Now we're willingly giving money away to the grandkids. You know how that works.
You do it happily now.
Yeah.
Okay. All right. Well, we're going to let you get on with the presentation.
Sure.
So take it away, Jeff. And I usually interrupt and ask a couple of questions or make a couple of comments during it, but I'm sure yours will be so clear and concise and on point. I will just sit here silently.
Well, on point, maybe clear and concise. We'll let them be the judge of that. I definitely have a path I'm headed down, but as I mentioned, I take a rabbit trail or two along the way. So we'll try to make this quick and easy. And Mark hit it right. Why Columbus Life is often the position that we're in. The slide that's up, if you're seeing it, is Discover Columbus Life. It's we've been around since the 1880s, in one form or another. And interestingly enough, a lot of people don't know who we are. We've been on the agency side for a long, long time and just been kind of flirting with the independent space. So a lot of times we spend time, who are we? The two names on the, you catch my name on there. Jennifer Bunning is sort of my better half, if you will, from a work setting. She is the internal wholesaler that will support you. There's a whole team there on the sales desk, and we'll touch base about that in a bit. But I want to give her a shout out because she is the one that gets it done. Couldn't do a presentation without all the fine details that Mark can appreciate from the legal side of disclosure. So we'll make all our posts and claims here, and we'll jump right into the presentation.
So if I could just interrupt for one moment,
Sure.
Jeff, and I'm sorry I neglected to say this. This is a pre-recorded video, and so you really don't have the opportunity to ask any live questions. So if you do have any questions, please reach out to myself or reach out to your marketer here at SMS, and we'll be able to get those answers to the questions that you have. All right. I'm sorry.
Yeah, you bet. No problem. Yeah, I know sometimes you go through these things and questions do pop up. We don't want to leave you hanging. Let us know. Reach out to the SMS team or Jen and I will be glad to help you out. Sort of fine tune your interest in the company. So when I approach these things, oftentimes I think, okay, well, do I give bullet points? Do I give niches? Do I give sales ideas? It's kind of all over the place. And I'll be honest with you, it's come to me lately that I think a better place to start, given the current marketplace, is a story. And everybody likes a story, but I think it helps tell the discover why Columbus Life type thing. And it really comes down to a choice. And we'll talk about that choice as we go through this. But the story actually starts with you, the agent. Oftentimes you ask an agent, or an agent gets asked what business they're in, and they say they're in the insurance business. I would counter that with say, you're actually in the client business, client finding and solution solving, problem solving business. Your income is largely driven by how many clients you can find and how many problems you can solve. You often do that with an insurance product, and on the life side, that's to deliver cash, living benefits, or a death benefit at the end of the rainbow, when it's needed, just in time. That's the problem that you're trying to solve, is to give that protection to the family. And that alignment that you have with the client, I think, is the real bond. You get paid by the insurance sales, and oftentimes we say we're in the insurance business because that's where the money comes from. But really, we all know finding the client and helping them solve their problems is really what generates the income. But I say that because one of the most important things, and if not the most important thing, is when it comes claim time, when it comes time to get to that cash, living benefits, or death benefit, the company is there, the benefits are there, the product performs, and it does what it's supposed to do. The challenge oftentimes, particularly in this world, fast paced, everything's quick, quick, quick. This is a long-term endeavor. Insurance companies could pay tomorrow, but they may not pay again. They may not pay for 50 years. It could span a considerable period of time. So back to the word choice, choosing wisely at the beginning helps ensure that long-term commitment that you're putting together in that problem that you're solving, that there's going to be cash, living benefits, or a death benefit out there at the end when it's needed. What I say is the last place you want to surprise is at claim time. And you want things to flow and move like they're supposed to. Well, that actually lines up very well, and it starts to answer the question, why Columbus Life? Because our interests are very much aligned with you and the client, and I'll describe that in a couple of different ways. One, we're a mutual company. And those of you familiar with that, we often say we're a highly rated mutual company with a top tier IUL portfolio. That's who we are, but more importantly, it's how we approach the market, as Mark was saying, and how we approach the sale for the client, because we do think of that long-term thing. What does mutual company status have to do with that? Well, if you're familiar with the sort of the structure in life insurance, you have stock companies and mutual companies. There's a couple of others, but those are the two predominant versions that are out there. I got my start on the stock side. That's kind of where all the brokerage business was going down in the early days. Sort of morphed even more so in the 90s as some mutual companies went away and demutualized. But in this day and age, it's the mutual companies that have all the strength and have all the staying power. In the 80s, there was 2,700 insurance companies. Today, there's less than 800. So a lot of the companies, and you've seen it yourself, companies that, you didn't think were going to go away, just stop doing business or get gobbled up by somebody else and they're gone. So a mutual company has a different outlook. We have sort of two constituents that we're concerned ourselves with, the policyholder and the agent. A stock company, by contrast, has the agent and the policyholder, but they also have the shareholder. And the shareholder is where management is trying to drive value because they actually own the company. So you're trying to drive value back to the owner. But that creates a tug of war between the policyholder and the stockholder. And I've seen it. I've been on both sides. It does make a difference. And I think there's also a tendency, because the stock companies are in the marketplace. They're doing, analyst calls. Things are tied to performance, is often tied to stock performance, which is what value I'm driving and it creates a dynamic that I think causes decisions to be made that wouldn't be otherwise made if you were focused on what we say on the mutual side is sort of the long-term component of our transaction and what we sell. So we've been around, as it says, since the 1800s, Fortune 500 company. That's a picture of one of our tallest buildings. And just to give you a sense, when they say one of the strongest companies in the world, what they're talking about that, yes, we have strong ratings. A Comdex rating is a numerical equivalent of all the ratings that are out there. If you have the top rating across the board, you'd have 100. The industry average is somewhere between 81 and 84. And we're at 97. So we're way above average. And in fact, we're right up there with the big ones that everybody thinks about as the stable, secure companies. But when you dig deeper and look at the financials, we're even higher than that, sitting at the top in terms of liabilities to asset, capital asset ratios. We're significantly, the industry averages in the single digits. Mutuals are usually the low double digits. We're sort of mid-high double digits. So we're way up there relative to the pack. All that says is we've got the fortitude, the discipline, and the outlook that says we can weather any storm, we can deal with any issue, and we're not going anywhere. The joke in this screenshot, if you can see it, is that's one of the tallest buildings in Cincinnati. It's the building Western and Southern built a few years ago, and it's one of the most sort of dynamic features of the skyline. And right at the top, there's a little red thing you might be able to spot. What that is a company name, just like on top of a lot of major buildings. And when the building was built and ceremonies were happening and the chairman got asked, okay, you built one of the most interesting buildings in the skyline of Cincinnati, but you put another company's name. In fact, you put another insurance company's name on it. Why? And he said, because I like cashing their checks. And it's that money mentality that drives a bunch of the decisions that go. And it's always looking down the road towards that long term. So that's one aspect of it, is sort of the mutual status, the financial component. And there's another component to it too. We've got a diverse portfolio of companies that Lafayette, which is our whole life company. We've got Integrity, our annuity company. We've got an investment company, a real estate company. We've got a small career division. We bought Gerber Life, was our most recent acquisition a couple of years ago. So we're diversified in the approach, but one thing that you'll notice, predominantly we're in the insurance business. That's been part of the challenge that I think is crept into the equation in the last 5, 6, 7 years, are these private equity groups that are coming in, and their play is short term. They're looking for a liquidity event somewhere down the road, less than 10 years. And as we say, insurance plays are 30 plus. And so it's going to set up an interesting dynamic. We've already seen it. One of the biggest companies, oldest in Texas, is no longer selling life insurance. That stuff happens. It kind of came as a surprise, but it didn't come as a surprise the way the market hits. So making a choice to who you sell is back to that alignment that we talked about at the beginning with your client and the solutions that you're trying to provide with financial products, and having them be there. The other component to that is a business decision, business mindset, if you will. Not what I think has happened in the industry in the last 10, 15 years, and it just has gotten crazier and crazier, is this sales mindset. Now, I'm the old school sales guy that, believes in the statement that says nothing happens until somebody sells something. I grew up in that world. I believe in that world, but I also believe you've got to be good stewards of the money and have the right perspective. And I think some folks have lost sight of that in the quest for sales. They've made some decisions that have, I think, going to challenge the outcomes down the road. And I'm already hearing people go through claims, particularly on the living benefit side, and the line I hear is, "Jeff, I didn't think it worked that way." So we're going to touch on that as we go through. So I'll touch on the business aspect as we go through this next section. I'm going to hit some product stuff real quick. And it's again just sort of positioning, but it's more importantly how we think and how we build product. And we've got 3 IUL products. Explorer Plus is our main product. It goes 25,000 to 25 million, 0 to 79, an all-around, all-purpose product. A slew of riders, some real niche stuff that we can do there. It stood the test of time. It is a really, really solid product. It has spawned two additional products built off the same chassis: a survivorship product, which is great when you have 2 lives, want 1 death benefit. I can take one in an insurable, because it's not wrapped up with the guarantees that are often associated with living benefit or survivorship. I can build cash. So one, I can build low cost to 100, 120, application fairly easy for the right client. I can also take a 50, 55-year-old who's ready to double down for retirement and drive cash, and I can do it cheaper in a survivorship product than I can in an individual product. So it has that component. And then for those that like the concept but want fast, quick underwriting, we do have accelerated underwriting. It's fluidless, examless, decision in 36 hours, policies in 3 to 4 days. That IUL Now product is just grows and grows. To me, it's the try it and you like it. What we find is people have a company, they have a path, they're used to it, they know how the everything works, and so they're hesitant to change. I get that. Change is difficult for everybody, but once they switch over, they really like how it works. We're getting a 70+% throughput, and that's a true 70%. The way some people measure it, you could say we have a 90+% throughput, because you can go to regular underwriting after that.
Okay, that's pretty impressive. I mean, to have a throughput at that high of a rate, that's incredible.
Well, and from a company that traditionally is fairly conservative in their approach, they really went to school on it. And the good news is that that concept, they believe, is the future. And why right now we're sort of accelerator underwriting 1.0, 1.5. We're going to 2.5. There's some commitments already made, money being spent, and systems being put in place that this time next year we'll be talking about new and improved, older ages, larger face amounts, even better throughput options. So stay tuned. Improvements to come, and it's just going to get better from there. But in terms of how we build products, and back to the business decisions and sort of that conservative nature that I mentioned a while ago, part of what when companies approach a product, particularly the IUL product, man, it's all about the illustration, and it's just philosophically not where we live. I I understood a lot of some of the stuff in the early days when the games were started, and I admired the ingenuity that these actuaries came up with to drive performance in the product. But I did not like the lack of disclosure, which bordered on almost deception and putting clients in riskier situations than they thought. Because remember, IUL is upside protection with upside growth with downside protection. Upside growth, downside protection. Well, when you start playing some of these games and building extra added expenses into the product, if you don't get the performance, the product is more expensive than what it's being illustrated. And particularly when you take an illustration today at 35, 45 years old and drive it off into eternity, compounding growth, we know what happens to those numbers. You make a small assumption today, but compound it over time, it makes a big difference. I was finally getting tired of getting beat up, and I was in a company meeting with the president, and I said, can't we do this with better disclosure? Can't we do this? And he said, Jeff, if we go down that path, we're going to be a much smaller company, because if that's our only choice, we're not going down it. I later came back at it with an actuary. How about this? How about that? Just on the illustration. And he goes, Jeff, you have to understand something. AG 49, if you don't know, is sort of the regulatory stuff, the insurance commissioners have come up with to try to rein in some of this crazy stuff that's going on in illustration. They've taken 3 bites of the apple trying to get it at that. They're actually in the comment period for the 4th round of that. But the actuary says to me when I say, why can't we do some of this stuff? He said, you have to understand something. We don't just follow the letter of the rules from AG 49, we follow the spirit. And I got to say, every time an illustration that one of these regulations go down, everybody makes changes, and we sort of pop to the top because now everybody's competing on a level playing field. And the strength of this product is old-fashioned. We keep prices low, and we let performance speak for itself. If you don't put too much pressure on performance, you don't have to play the games, and you keep expenses low, you're doing the right thing. So to put a fine point on that, I'm going to show you a couple of quick slides. I'm going to talk conceptual. I'm not into product. I'm not into the actual numbers I'm showing. I'm just talking about positioning and what a difference and what some of the games that some of this had. So we moved our cap rate up at the end of last year, and it went, if you're looking at the screen, yellow to green. It sort of moved from below middle to, below the top, the first tier, which we thought was the right direction, the right movement, and that we wanted to go, but it just didn't get us where we thought we would land. So then we said, well, what do all these other companies, how are they running their illustration? So we did a deep dive, and what we realized is they were all using their default index. If you go into their illustration system, run it, what happens? They have a default index. What that default index is the volatility control index. That index was good conceptually. It was bad in execution for a variety of reasons. But 1, it hasn't performed. And 2, it's got a lot of bonuses and stuff I was talking about earlier that says, I'm going to give you 135% bonus, but I'm only going to guarantee 25 basis points of it. So it sounds good, or I'm going to give you performance when it performs, but if the market doesn't perform, I'm not going to give you any bonus. Well, that's when you need it, right? So what we did was we went back and we ran everybody on the AG 49, the S&P 500. We went back and we reran this, put everybody on the S&P 500. And what happened is we went from sort of just below the first tier to almost the top, number 2. And I would argue, given some of the games, I know who some of these companies are. Yeah, there's other aspects of the illustration that you have to be wary of. So happy to talk about any of this. If those of you that are product and interested in wonky and want to get into it, I'm a little bit of an insurance nerd, happy to dive into that conversation with you. I'm interested in people's thoughts and opinions about it all. Everybody's got a favorite. I'd just say the business mindset that we take again assures that we're not going to have a surprise at claim time. And in this particular case, what I think about our illustrations is we're not over promising so that we're under delivering for the client. And think about that. If part of your job is providing solutions for clients and also finding clients, if you're disappointing clients, it sure makes referrals hard. But if you're giving them solid benefits and things, there are no surprises, and you didn't overpromise and you delivered, you'll have all the clients that you know what to do with. So again, the point to this is choosing who you put in front of your client is important. It's easy to get caught in the illustration game and say, wow, these numbers look great, but it's that long-term performance that you're after. All right, so living benefits. I'm going to touch on this. I'm going to try to run through this pretty quick, get to a sales idea, and then something near and dear to your heart, compensation. We'll touch base on a couple of things at the very end that are a little unique to Columbus. So living benefits are a central part of any sale today. When I started, that it was just death benefit. We rarely even talked about cash value. But today it's terminal illness, chronic illness, and specified medical conditions. There are two principal ways in which most of those riders are built. The two principal riders don't cost you anything until you use it, but how they're designed impacts how the claim works. And I've come to this because I've been told by a number of first producers with firsthand experience, some on their own family, that back to my point, Jeff, I didn't know it worked that way. So the difference is there's the lean method, which we use, which is like a loan, and then there's the discount method, which is what is predominantly in the industry. And the discount method uses a formula that I've got on the screen that came out of an actual policy. And you'll notice there's a bunch of unknowns, if you will. If you remember your high school algebra, you had to solve a problem with multiple unknowns. Well, that's what this is. And the reason this problem can't be solved when you're by the policy, paying premiums, and only at claim time is because those unknowns are information that you can't offer up until you've got a claim, which is what is the age, what's the cash value, what's the death benefit, what's the person's condition, what was the diagnosis, what's the prognosis, what's their life expectancy. All those figure in. One of the producers that called me, well, it was on his wife. It took him 4 months to get to this answer. And I've been told this, and when I do these presentations, somebody always meets me at the back of the room and says, Jeff, what you're talking about on those living benefits is actually true. I went through it myself. I had a producer do it just a few weeks ago. He had tongue cancer, and he said, I'm scrambling to try to take care of my family and cover the bills and get through this diagnosis to a positive side. And he said, they couldn't tell me anything of what I was going to get. And that's a challenge. The second thing is, and this was reminded of me, is the discount is often on the death benefit. So what they're doing is they give you this, you could have up to this amount of money at illustration time, but when it comes claim time, the client remembers the big number, but what they forget are the two words that preceded that comment, which is up to. And the determination of up to goes through this formula, and it comes back to some other number. And that's a disappointment. There's a big lawsuit going out in California of sales practices around living benefits and the way this thing works. But what got my ear, and I've heard it multiple times, is the way the death benefit gets discounted. This guy had $350,000 on his wife. He said to get the $30,000 critical illness claim paid, they had to accept a reduction in death benefit from $350 to $150, a $200,000 drop in death benefit. And his comment to me says, so my kids are going to have to give up $200,000 if something happens to mom so that she can have $30,000 a day. And that's when he said the magic words, Jeff, I did not know it worked that way. So ours is a little more open, transparent. We need two numbers to figure out how much you're going to get, what's your cash value, and what's your death benefit. You give us those two things, and we can tell you at any given time. You could be driving home from the doctor with a bad diagnosis and say, I just got diagnosed with this. Can you tell me how much I'm going to have in this living benefit or that benefit? They may not be able to tell you on the phone, but within 24 hours, they can give you a number and tell you what that is. So ours is 100% of the cash, a percentage of the death benefit. It goes on the loan as a policy, and we charge an interest rate just like any other loan. So it gets treated like any other loan. The client can pay the interest, they can take it out of the policy, they can continue paying premiums, or they can take it out of the policy, and they can pay back the claim if they want to restore the policy. And in my friend's case, where he had $30,000 critical illness claim, that $350,000 death benefit would have been reduced to $320,000. That was it, just like any other loan that you would take on a policy. So again, no surprises. You can calculate it yourself. You can understand how it works. You can see it. Again, it's transparent. So what we like to say is, it's a simple calculation. There's no additional underwriting. We're not digging into the file at claim time. We need two things to file a claim. We need a claim form and we need a doctor's note. Can't do two of the 680Ls. They have this diagnosis. They're going to be terminal. Two things. Our average claim time last year was 4 days. They set aside 10 days, but they got it done in 4 days is an average last year. So that shows you it's not a complicated process. It's not a complicated calculation. Illustratable benefits on all our illustrations. It's living benefit across the board, year by year by year, and you can see exactly what's being projected that they'll get. So no gimmicks off that. And there is a residual death benefit. There will always be a death benefit. There are some of these I've heard where the policy actually goes away. Just goes away. And again, back to the client saying, I didn't know what I was going to do. But Mark, where are you on time and a sales idea? Because I've got one we can go through if you want.
Yep, that would be great.
All right. So what I'm going to do is take my IUL Explorer Plus product, and we're going to solve a problem for Mrs. Sweet here. 62-year-old, good health female who has some money set aside in a bank or an annuity that she doesn't need to live on, and it's her just in case money. And you say, well, if you don't need the money, where's it going to go? Well, church, charity, kids, grandkids. And you come back to them and you say, what are your plans for your money? Do you have life insurance now? And if I could show you a way to leave more money to your beneficiaries, protect your nest egg, would you be interested? Sure, I'm interested in looking what you have to say. What do you got? So what I'm going to show you next is an illustration. A lot of numbers on a page like an illustration, but I'm going to walk you through it left to right. So what we did was she had $100,000. We put it in a premium deposit account. That helped us keep the death benefit from going crazy and making it a mech. So, and we pay interest on it. So 100,000 turned into 105. We spread it out over 4 years. Money goes in, chink, 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 just like it shows. On the far right side, you'll see the cash value. Put in 26, you have 22. Put in 52, you have 46. We put an early cash value rider on this that does not diminish commissions. So what have I done? I've put money in a premium deposit account. I put an early cash value on it. And in net result of that is I've protected her nest egg in the sense that I've given her additional liquidity. That premium deposit account can be collapsed at any time. She could make one payment and say, I want the other 75 back. And back to her in the bank it goes. If she wants to collapse it completely, there's a minimal cost to it because we did the early cash value rider. So from a liquidity standpoint, and she's back to even by the time 5-6 years into it, she's back to where she was to begin with, and not, and at that point, no longer getting 1099s, but getting the growth. So that's a cool aspect of that. But then look at this. Look at that $329,000 death benefit. Before she had, she didn't use the money and it went to the church, charity, kids, or grandkids, they were all dividing up 100,000. Now they're dividing up 300,000. So now I've tripled how much money can go to the beneficiaries. I can spread the love even further, and I've protected my liquidity. And oh, what's the most important thing people think about in terms of the just in case money? It's obviously a health situation. When she's 75, the living benefit, the chronic illness rider was over 200,000. So in a little more than 10 years, we doubled her money for living benefits to 200,000. So we took 100,000 of idle benefits. We turned it into extra money for beneficiaries. We turned it into double the money in a living benefit situation. And at the same time, we protected her liquidity. You could do this with $100,000 case or $1 million case. The numbers work the same. You just add some zeros. So this to me is a great, folks are often in the house for other reasons going through thing, and they in their fact finding, they run across, money like this, it's been inherited. It came, in a, spouse passes away, property sale, whatever it might be, it's just sitting there as idle money. So this is one idea. I've got another one we can share at another time that's similar for a retiree that works really well. But we're going to conclude.
So Jeff,
Go for it.
I'm just going to ask you a question, but go back to your illustration. And so we've got the 105,000, 106,000 that we're putting into the premium deposit account to spread the premiums over 4 years, so you don't turn it into a mech or have a crazy high death benefit. And you said that in years 2, 3, and 4, if she had a need for money, she could choose to pull the money out of the premium deposit account.
Correct. It's got kind of a one-time surrender feature to it, and it can be collapsed. Yeah.
Okay. And then what happens to the life insurance at that point?
At that point, it just sits there like any other policy, and it's going to last as long as there's cash in it.
Right.
And if she continues to fund it, and she could flip it around. She could say, you know what, rerun this illustration. Tell me what's the least amount I have to pay every year, and keep it in force. And because it's got high early cash value rider, I back off. She takes the 75 and she just strips it in there every year as a small annual payment that goes until she passes.
And so that doesn't have any effect on the compensation that's already been paid in year 1.
That's right.
Okay.
It's a good question.
And that's a good point for all the listeners, is that if she decides to do that, you're not going to get charged back on anything.
Nope. Good question. Good question.
That's fantastic.
Yeah, one thing that I thought was fairly common, but on our life and our annuities, there's no charge back at death. I'm surprised some companies have that, but apparently they do. Okay, part of being associated with an old line career type agency type company is we still do trips. We very much value company relationships. Our management team does a fantastic job of coming to these meetings with an interest in getting to know the producers. They don't just sit behind, on stage or behind a podium. That they mix and mingle. They're at the pool. They're on the excursions. The first trip, which next year is this Boston trip, it's a family trip. Bring the kids, bring whatever. Normally that trip, that first level trip, which is the Boston trip, is a Caribbean trip somewhere. I mean, we've been to Aruba, Puerto Rico, Bahamas, Grand Caymans, all sorts of places. We've done Maui on that trip. The Ireland trip we don't necessarily always do international, but we do. And this year's going to be a great trip. It's usually a step up from the Caribbean type trip. It's sort of next level this year. We happen to be going to Puerto Rico, so we're all flying into San Juan. We're staying at the Fairmont, having sort of that first level trip, and then everybody leaves, and the the top level trip guys roll down the beach to what I didn't even know existed, but a sort of a black label Ritz-Carlton. I didn't even know such things exist. I don't guess I fit in that category. So apparently it's next
We're
level.
working folks, right?
Yeah, that's it. That's it. But there's rewards for working folks, and that's nice trips like this.
Yeah.
So I wanted to let you know that the rules are pretty straightforward. And contact Jennifer and I or the SMS sales team, and we can get you details. And again, we're super old school. We don't 1099 for these trips. It is truly you earned it, you get it. We're not going to send send notices to the IRS that you received a benefit. The last thing I want to touch on is sort of a feature of compensation that has pretty much long gone away in these companies' desires to have a competitive edge on that illustration. They are looking for every dollar, everything they can to squeeze out and put into performance in the product, which I get, but one of the things that got lost is, renewals have gotten smaller and smaller and smaller. Service fees are long gone. Well, we have something that's kind of unique. We pay Target, we pay excess, we pay renewals, but we also pay trails. And if you're not familiar with trails, they are an asset-based commission. It is, everything else gets paid on premium, and the trails get paid on the cash value in the accumulation account. It's a small percentage. It's not, one policy is not going to ring the bell, but I sell multiple policies a year. Next year I sell multiple policies. Next year I sell multiple policies, and the numbers add up and they're significant. The most important thing is you don't have to give up anything to get it. There was a point in time as these things were fading out, producers could have a choice. I'll take all my comp up front or I'll spread it out. This isn't one of those choice things. It's automatic, you get it. So we asked the company to give us some real numbers. So we found a producer, just sort of, I don't know how they got him random. He was selling 3 or 4 policies a year, decent sized policies, but over 15 years. And last year we sent him a check for about 11 grand. He didn't have to do anything extra to get it. He just got 11 grand in the mail. Thanks for playing. In his total career with us, he's gotten $136,000. And he didn't have to do anything but go to the mailbox to get that. $136,000 extra dollars. We were talking about money. There's some money for those kids or grandkids right there that you did the same work, you did the same effort, and you got paid. Well, being the sales guy that I am and sort of wonky, I said, okay, what if this cat sold 20 policies? And I did the math, just using the same formula, just multiplied it through. 20 policies would have netted this guy $43,000, not 11. Now you're starting to talk about some real money, right?
Right.
And his lifetime number would have been in excess of 400,000, probably closer to 5+. And all he did was make a choice to sell Columbus versus somebody else. He took care of his client. He's thinking long term. He's thinking about I don't want to overpromise and underdeliver. I don't want surprises. I'm taking care of my client. And oh, by the way, we're rewarding agents who help us make that happen because we make money when policies stay on the books. And we're willing to share some of that back with the producer base to say, you help us, we help you, and we all end up helping the client. So it is a long-term view. It's a long-term play, but it all starts with a choice. What I started with at the beginning, it's a choice.
And so we're looking for the hand raisers within the SMS advisor community that's going to write 80 policies a year. I think that's a good goal for everybody that's watching, right?
Sure, why not? Why not? I've actually run some performers on some guys that sold at that level and higher, and I'm telling you, it is serious money. And two other little components to this that just make it crazy. There is an override component to this. So if you are running an agency and you have a downline, as the upline, you get a piece of trails on every policy sold underneath you. And that number stacks up ridiculous because you've got a decent downline and they're all doing 20 to 80 policies. It I've got some pieces I can share with you on the agency level if that's of interest to you, so you'll know what that is. The second thing and last thing I'll leave on all this is you are vested 100% in all your commissions. You can go, which means the money's yours. It's always going to be yours. You can leave the business and we're still going to send you checks. You can go open a surf shop. As long as we have your address, you're getting money. But what's interesting is we also get a beneficiary designation on your contracting. Why? Because if something happens to you, you're vested in that money and that's going to your beneficiary for as long as those policies are in force. So you talk
That's
about a
great.
legacy, you talk about a choice a company could make. Oh, let's just dump this and it'll save some money. Nope, it's your policy, it's your money, and your beneficiary doesn't have to be contracted or licensed to receive the money. So again, get paid more for the same effort. There is the magic number for the Columbus side. You all have relationships at SMS. They know how to get a hold of us, but obviously feel free to hit that. This group is sort of our secret weapon. They're more than just illustrations and product information. They can help you be that concierge. Hey, I've got a case that's stuck in underwriting. Hey, I've got a commission problem. Hey, I've got an enforced policy that's messed up. They may not be able to solve it, but they know the right people to do it, and can get you to the right folks so that you're not bouncing around the building. So that in case of emergency, break glass. It's in case of emergency, dial that number. Those folks can bail you out.
Yeah,
So
and I would say for Columbus Life, I mean, everybody works every day in the office, and it's actually in the office in Cincinnati. So it's, you know, we don't have remote employees, or they don't have remote employees, and everybody's working every day. So if something needs to get done, it's a lot easier to walk down the hallway sometimes than it is to set up a meeting and Zoom or phone calls. So I encourage you to all look at them. Just let me recap. I took a couple notes. So we've got a almost 140-year-old company that's a mutual company that's not dependent on quarterly earnings, so they look to the long term. We've got a 97 Comdex, which I'm not sure that, you know, we work with any carriers that have a higher number than that. They have 3 great IUL products. They have honest illustrations, so there's no games being played in those illustrations. They use the lean method for their living benefit calculations, which, you know, I think that's the best thing I've ever seen with regard to any sort of a living benefit payment. They had a sales idea that, you know, I think some of the folks in our building would say, if you find money like $100,000, put it into an annuity. Here you can put it into a life insurance policy, and it's a better deal for the client, and it's a better deal for you as well. We have trips that are available with no 1099, and then you offer trail compensation. So I don't know what's could be better, right?
yeah, I often wonder why we're such a well-kept secret, but we are one of the best kept secrets in
So
the industry. But as you know from your advisory folks and all the folks that have found us, it's been a great relationship.
yes, absolutely, and it's been a great relationship with you and all the folks at Columbus Life. We really appreciate your support, and I encourage everyone that's listening on the call to give them a try. So I think you'll be very happy with the results. Well, thank you, Jeff. Do you have
Appreciate
any
you, appreciate the team.
do you have any parting words for the listeners?
Well, a couple of weeks ago, it might have been baseball or basketball, but those are over. So now I guess I'm ready for football to start. I'm sure there's a few of you that feel the same. They're ready. That summertime itch.
Yeah, this is the summer lull when we start
Yeah,
looking toward fall. So,
yeah,
all
that's
right.
it. No, no
Well,
parting words. Thanks, Mark. I
yeah.
appreciate it.
Well, if you have any questions regarding Columbus Life, be sure to reach out to me or reach out to your marketer here at SMS, and then we can get those questions answered and we can start your next case. We're looking forward to working with all of you that are listening on the call today, and we'll talk to you soon. Signing off from SMS, the Smart Lions. Thanks.